Hello and welcome to the Unleash Your Retirement podcast with your host, David Koren. I'm Wendy McConnell. Well, hey there, David. How you been?
Fantastic, Wendy. How about yourself? I'm enjoying this nice fall weather we're getting, where we're finally cooled off and getting some sunshine and everything. I know that a lot of people, we've had a lot of hurricanes down south, but here in the Mid Atlantic, it's very nice.
It is. Yes, and the leaves are starting to change, and that's always one of my favorite little, festivities to do and drive around and look at the leaves.
Yes, it is very
Yeah.
nice. I love being able to do that. And I'm going to get out. The leaves haven't turned here yet, so we'll this be a
You'll
little
get
bit, but
there.
they're starting. They're getting there. Yeah.
Yes.
So we'll get out and do that.
With the fall comes the big presidential election, and that's what we're going to be focusing on today, right, David?
That is correct. I invariably get a lot of questions about the election from both sides. People are just, for some reason, the public in general seems to panic a little bit and worry about the other side winning. And unfortunately, today I've never seen the two sides be so polarized as they have become of late. So this election cycle is unique in a lot of ways. First and foremost, we have, well, for the first time in memory, I don't know even when it happened. I know it's happened before, but it's rare that we have a sitting president eligible for another term who's not running. So in other words, Mr. Biden, President Biden is not running for a re-election here. Instead, Kamala Harris has been drafted and she's in his place. Now that's sort of unprecedented in a lot of ways. So it makes for a very different dynamic with this election cycle. In addition to that, you have a former president running in Donald Trump, who lost the last election and is running again, and that's unique. So it's very rare that you have a former president run again. Normally they get two cycles, and they're done. They get 8 years and then they're out because they can only serve 8 years. But because he didn't get elected again, he can run again, and he's chose to do that. So you've got this, and most people would agree with me. I'm not sure that it's true of everybody, but a lot of people feel like they just wish they had different choices.
Yeah, they
But
say that
that's
every year, right?
every year. But you can't, that's the top of the ticket is what it is, and this is what we're going to vote on coming down the pipe. Now, I will say this right away. First of all, presidential elections do not have a big impact on portfolios. Politics in general don't have huge impacts on portfolios. Some of the policies that do get implemented can impact the markets. Okay, so it's really about the end game of what happens here. So the time that the markets tend to do the worst is when one side or the other, Republican or Democrat, dominates both houses and the presidency. So if you have a Democratic president with a Democratic controlled House and Senate, you will see a poor market. That's the history. And the same thing is true with a Republican president with a Republican Congress. If the markets do not perform well. Conversely, I find this sort of interesting. If you have a Democratic president and a Republican controlled House or Senate, the markets tend to do quite well. Actually, they do just as well as if the two houses are split. And the same thing is true with, well, not as much, but if there's a Republican president and a Democratic controlled House and Senate, then you get a situation where the markets underperform. Actually, that's one of the worst categories: a Republican president and a Democratic House and a Democratic Senate. The time that you get really stellar performance with a Republican president is when you have a split House, where it's partially Republican, partially Democratic. Then we get a good return on the market. And what I tell people all the time is this: it's not really who's in the White House. It's not. It's when we have a situation where both the House, the Senate, and the White House are controlled by one party that you worry. That's the time that I'm concerned. Um, and the reason for that is because they're more likely to be able to implement their policies. Okay? And I think that that's so important. So you can look at both sides, what Vice President Kamala Harris is saying she's going to do. You can look at what President Trump says he's going to do. But the truth is, it really doesn't matter unless both the House and the Senate belong to that party, because they won't be able to pass diddly squat. That is why the market, by the way, loves a divided government, because very little changes. And if you think about it, that makes a lot of sense, right? Because policy changes cause companies to do what? They make policy changes, tax changes, what have you. What happens? What do businesses and individuals have to do?
Well, they get worried, right? And they don't invest as much.
They have to change
Right.
behaviors. Okay.
So I was right? I was right.
You're right. Yeah. It becomes unpredictable.
Yeah.
So the future and the unintended consequences of new policies, which we don't know what they are, it's all becomes very uncertain. And the one thing that the market hates more than anything else, economy in general hates it, is uncertainty, right? The more uncertainty there is, the more volatile the markets will behave, and more than likely they'll underperform. So if we get an underperformance situation in the markets, we have to be concerned and usually it doesn't happen unless we get big policy changes. And that is when politics really does impact the market. So an actual presidential election is probably not going to move the markets. I'm not really expecting, regardless of which side of the house of the spectrum wins. And again, it's a toss-up at this point. Nobody knows who's going to win right now. It's really, I think I've heard it's as close as it's ever been, but I've heard that before. But it's certainly going to be a close race by all the polling data that I've seen. And so as a result, we are likely to be in a situation where we still have divided government regardless of which side wins. I believe it's very unlikely. I mean, it could happen, but it's very unlikely that, let's say, Kamala Harris wins the presidency and then they're able to retake the House and they hold on to the Senate. I think it's possible, but the odds against that are pretty high, right? Very, very high. And by the same token, the odds of Trump winning the presidency and seeing the Senate be taken by the Republican Party, because it's controlled by the Democrats right now, having them win the Senate, take back the Senate, and hold on to the House, which it's razor thin in the House right now, even though Republicans control, it's razor thin. Could go either way. I would be shocked if Trump wins and that those two things happen. Even if it did happen, I think that there would be a very thin majority in either the House, both the House and the Senate, like there is now. Super thin majorities mean that very policies don't just get pushed through. Things take time. There's a lot of wrangling and back and forth, and usually whatever the policies were proposed by the candidate when they were running, whatever those policies that what actually ends up getting implemented is very different. I'm not going to, it's not going to be the same. And so that's really a good thing in the long run. So I say to my clients all the time, you don't have to pay attention to the election. The election is not going to make or break your portfolio. What is important is that you remain invested. Okay, you don't pull your money out just because the other side won. Because if you do something like that, by the way, that's some of the worst returns. If you were to put your money where your mouth is, there's some studies that have been done where people so what if you were out of the market during the Democratic presidency or out of the market during a Republican presidency, and then you went back in whenever it switched. Okay, and they did that study, and believe me, it's terrible. You're way better off just staying invested, riding through whatever storms may come. You just need to be invested in a portfolio that is suited to your risk tolerance. It's really about the client's risk tolerance. It's something we stress a lot. We spend a lot of time talking about it with clients because we do not want, the worst thing people can do when they think about their money is to try and time markets and jump in and out for any given reason, right? It doesn't have to be a president. It can be other reasons too, but trying to jump in and out and time a market just doesn't work. I mean, you might hit it once or twice, but in general, it's not going to work.
So it's like we have to remember it's about playing the long game. That's really what we're always encouraged to play the long game.
Play the long game based on your goals, your objectives, and stay invested in a model that meets your risk tolerance levels. Okay, so that is what is really the most important thing, to stay invested. And the way you do that is by being in a risk model that is appropriate for your risk tolerance level. So that if the market goes crazy and it drops by 40 points or 50 points, and you're down, but you're not down that much, okay? And you're okay with that. What is your tolerance? If you can handle the market going down 15 or 20%, then you can be in a pretty, growth-oriented portfolio, but still have bonds and things that offset your mix so that you don't see that big of a drop. When the market goes down 40, you go down 20 maybe. You go half as much or something along those lines. And you're still going to be fairly aggressively invested if you go down that much. And you're going to benefit from the ups, and you won't go down as much when the market goes down. So that's what's critical. You want to be in that personal sweet spot that you have where you're comfortable with what can happen to the market given your portfolio. That's the key. If you're stressing all the time and worrying about it, that's not good. You want to be in a position where, hey, I'm okay with this. I understand the market goes up and down. It will recover. I don't need this money until XYZ. Okay, and the money that I do need is safe. So that's the other thing we stress. Money that is needed for income purposes and things of that nature, we have that in safe positions in the portfolio. So, and we try to make sure that that's set up that way for at least a 5-year period so that no matter what happens to the investment side, what's in the market, in the portfolio, what's in the safe stuff, the corporate bonds and the cash and things of that nature, that's going to cover you throughout all your income needs for the next 5 years. This is especially true for retirees. If you're still working, honestly, you don't have that concern because you don't need the income from your portfolio. You're not living, relying on your money to pay you back and provide you with an income in retirement. While you're still working. In retirement, you are. So it's a different scenario. So that's where we focus on that 5-year kind of planning approach. When you're still working, technically, that really just depends on your emotional comfort zone with the market. Because honestly, you could be totally in the market, especially if you've got more than 5 years before you need to touch the money, right? Because you should be able to weather any kind of storm. Let the portfolio go up and down. Doesn't matter because you don't need to touch it for a certain period of time. You don't need any income off of it. The closer we get to retirement, that's when we start building in and moving money to safer positions to meet income needs. That's real important when we start talking about getting close to or being in retirement. Is that income perspective. So that's all about cash flow management, and you have to go through that process with each client. Everybody's different. Some people don't spend nearly as much as others. They don't have as much of a drawdown that need from their portfolio, or they're in really wonderful positions where they have a pension and Social Security that meets all their income needs. And so their investments are really not needed either In fact, it becomes almost like a burden in terms of a tax liability because they have to take money out when they get to that required minimum distribution age. That puts them in a great position because we can be as aggressive as the client wants to be when that's the case, and only allow enough to provide for that required minimum distribution along the way. And a lot of times clients that are in that position take that required minimum distribution and give it away because they don't need it, so they use that for their philanthropic efforts. And that's something that we encourage people to do. So through qualified charitable distributions, you take your RMD, but you don't pay any tax on it because you give it to a charity or charities of your choice. And you can do that all the way up to $100,000 in any given year. So unless your RMD is over $100,000 a year, and there are people that do have that kind of an RMD, by the way, but most people don't have 100,000. It's well below that. But it's 40 or 50,000, not uncommon for clients that don't need the money to give all or most of that away. And we see that quite often. So I just encourage people, when you think about a presidential election cycle, to not let that sort of guide your thinking about your investments. They're separate. The presidential election is important. I'm not going to downplay that. You want to pay attention to it. You want to vote your conscience based on your beliefs and what you think is best, going forward for the country and that kind of thing. And you want to go in that direction. But it's not that critical to you. You shouldn't worry about your personal portfolio performance, and that shouldn't be a factor in your determining who to vote for. And you shouldn't worry about that, honestly. I mean, that's the bottom line. The only thing we worry about here as advisors is a situation where we have a sweep, and House, Senate, and presidency is controlled by one party by a margin. Especially if they have a decent sized lead, hold on the House and the Senate, where they can just basically push through legislation, because that's when you see major legislation, big changes come. And again, that creates so much uncertainty because of all the unforeseen consequences of that approach. That's when we get in trouble, and that's when the markets misbehave, so to speak.
So you want you want things to be a little one side, a little the other side, keeps things status quo, so to speak.
That's right. You don't want anybody taking total control because you don't want too much to happen. And you want there to be compromise. So, because usually within compromise, you don't get, it's not big, major changes with huge, unintended consequences. It's tweaks, which the markets can handle usually. Out there. So, big policy changes are a concern. Like I think one of the proposals by one of the candidates this time is to have a tax on unrealized capital gains for people making over $1 million a year. Now, that sounds good if you're thinking, well, hell, that doesn't affect me. I'm not making $1 million a year. That's only the big people, right? The problem with that approach, in my opinion, is that there will be a lot of unintended consequences. It will have huge impact on the stock market because it will change the behavior of people that make over $1 million a year, how they handle their positions in their portfolios. And that could really move the markets in a way that people don't realize or think about. I think it would be overall pretty negative, quite honestly. But more importantly, that kind of a rule could impact a lot of things relative to people who own businesses, farmland, things of that nature. It could have an impact on them because we're not just talking about estate taxes here, but also, because that's technically you have farmland. That's appreciated in time. It's an unrealized gain in a big way. You sell it, you make $1 million. They're going to go say, well, you got to realize all these other gains too, of other stuff that you have. So there's all kinds of situations where that could create problems. But the likelihood of that getting passed, even if Kamala Harris wins the presidency, is unless there's unless she sweeps both the House and the Senate, is slim and none, quite honestly, because it's a big drastic change that I doubt the markets would, that I doubt that they'll embrace. You know, in other words, there'll be some kind of compromise, and more than likely that thing will get dropped. Would be my guess. That kind of big move like that.
Because Congress won't really allow something like that.
Correct. That's right. They'll bicker and go back. They won't. It just won't happen. You know, they start making soup up there in Washington or whatever you want to call it, and it'll be a big mess and very different when it comes out on the other end. I've heard some people call it making sausage up there. So you know, it's just you never know what's going to come out on the other side of the aisle once they've gone through all their compromises and all the adjustments that they make to legislation as it goes through. So that's what you need to think about. Those types of things happening, it should give you some relief that, hey, no matter what happens, relative to who wins this election, the likelihood of all of their policies as they propose them being introduced is really zilch. It's not going to happen. Some of their policies may get introduced, but they will be changed, watered down, and nothing like what they originally were, and likely less impactful to the marketplace. So that's my sort of caution to folks when we start talking about elections. And they almost always ask me when they come in, what's going to happen if Trump wins again? Oh my God, the world's going to, or the vice versa. Well, we can't afford to have, Kamala Harris. I hear both sides. So I just try to assure both sides, when you're thinking doesn't matter. It's really about control of those houses and big policy changes that would impact the market. So if that's not going to happen, and again, not likely that we get that type of outcome, given how divided the country is, I don't see that happening. Then we should be okay. There will be compromise over time, and I'm hoping that these two sides can get better at working together, because one of the problems we've had is there hasn't been enough compromise. And that's what stalls everything. And then not enough good stuff gets pushed through. So we're not seeing a lot of positive changes that I think will be out there. So at any rate, bottom line, when it comes to the presidential election, don't sweat it as it relates to your portfolio.
It's not life or death when it comes to the portfolio.
It is
That's
not.
one thing that you could just stop concerning yourself over.
Correct. Set it aside in your mind. Don't worry about that. And then if you want to get involved in politics and do stuff, that's fine. And then vote your conscience, but don't worry about your portfolio relative to the election. And that's sort of, and don't try to time the election around that. I mean, I had somebody we met with recently, potential, it was a new client, and they were like, well, should we get into the market before this election? Because we don't know what's going to happen and all this. I said, listen, don't, you can't, you're trying to time the market.
Mm-hmm.
You're trying to make your bets as far as how you invest on what happens with an unknown presidential election outcome. And that's just not wise. Bet on the market, look at the market trends, look what's going on out there right now. And that's what you can look at and think through. And just get into a portfolio that is allocated in a way that you're comfortable, that you know the risk numbers, what the high-low is, what the standard deviation of that portfolio would be on a yearly basis, and can you handle that? That's what's important. You get comfortable with that, then you can withstand the storms, because we've been around long enough to know. I mean, the markets have been around since the 1900s or early 1900s, and they go up and down. That's what they do. We've had some big things like the Great Depression, the Roaring '20s. I look at that period and say, well, we might be in the Roaring '20s again. Who knows? We don't know, but there are business cycles that impact the markets, and that's what's really important. You have to track those and realize when you're in a recession what you need to be doing, and when you're in a boom period what you need to be doing. And I think in an earlier podcast I have talked about the advent of AI and how unbelievably impactful AI is going to be, and I'm saying going to be. Now, a lot of people have seen what's happened with NVIDIA, and some of the, the high-flying stocks related to AI have gone up quite a bit. But that's the front runner of what AI's impact is going to be. And I've said before, and there are a lot of people that really believe that artificial intelligence will impact us economically more than the invention of electricity. Okay? Now that is massive. So there's going to be massive disruption, massive change, but I think at the end, we are going to see an economy blooming and taking off in ways that we never even dreamed of. So I'm sort of bullish and optimistic about from that, and I think that's where we're headed. And I really don't think who wins the presidency has anything to do with that. That has to do with what's happening in the business world and the economy and how companies choose to implement and use AI going forward, which is what's happening now. And so we target companies that are investing in building out infrastructure to utilize AI now. That's more so than just the tech companies that are creating it. We're investing in companies that recognize how they're going to put that to good use out there. I think eventually it will impact every company, every business in multifaceted ways. And we're utilizing it already in our business. So I know a lot of companies are taking advantage. So I think that's way more important than the presidential election and something that we should pay attention to.
Yeah. So let's just worry about one thing at a time. You don't
Right.
have to worry about the presidential election, when it comes to your portfolio. So start worrying about AI.
Right. And where that's going. Yeah.
Right.
Worry about AI and start utilizing it. And, don't miss out. You don't want to be the person without the computer on your desk, and because that was a big change. But AI is nothing like this. You don't want to be the person that doesn't understand how to utilize AI in your workplace.
Right.
You want to be on the forefront of that. And if you do that, you're going to do well in this emerging economy that I believe we're going to be seeing going forward.
Okay. So, David, if people have more questions for you, how do they get in touch?
Go to our website, rvawealthmanagement.com. You can schedule a 20-minute Ask Anything session with me, and that's just what it sounds like. Ask any questions, 20 minutes, totally free. And also on our website, we have my classes posted. So when I'm teaching here locally at Randolph-Macon or University of Richmond, there's the ability to sign up on the website for those too. So and gain more knowledge. So I encourage people to reach out and contact us if they have some questions or interest.
All right. Well, thank you so much. And thank you for listening today. Please follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Unleash Your Retirement podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rvawealthmanagement.com or give us a call at 804-497-2100. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of RVA Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of RVA Wealth Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by RVA Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private client services, RVA Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.